Perhaps the most powerful tool we have in tax planning doesn't have to deal with loopholes, although those certainly can be helpful. Instead, what it does is it deals with our timing issues, right? When do we want to go ahead and recognize income or expenses? In December, or do we want to push those back until January? Well, that's going to be very fact dependent. And in this video, we're going to walk through the situations where you may want to accelerate deductions or income recognition, or where we want to kind of defer it until January. We don't want to recognize the income until January. We don't want to recognize the deductions until January. And there's all kinds of issues. It could be dealing with tax credits. It could be dealing with cash flow. Just a lot of different issues that can really impact that decision. So in this video, I will also talk to you about some of the key mistakes that I see taxpayers make in terms of trying to deal with their deferrals or acceleration of income or deductions. Sometimes they're not taking it in a strategic perspective. They're just thinking, hey, I need to go ahead and accelerate my deductions, or I need to defer my income, which is often the rule, but it's not absolute. So I'm going to give you those situations where I see taxpayers making a mistake. So let's go ahead and let's start getting into this information. So let's start out with our tax deductions. Now, before I get into that, let me tell you one thing. The amount of deduction, if you have a $200 deduction and you're looking at taking it in 2025 or 2026, it's still a $200 deduction. What's going to happen is your marginal tax rate may change, so that $200 deduction may be more beneficial in one year versus the other, but it doesn't change the amount of your deduction. It's just the timing issues which could impact us because of our marginal tax rates. All right, with that said, here are some of the common examples that we see when we're looking at timing issues, where it could make a big difference on when you're paying, whether you want to pay in 2025 or 2026 or whatever, December or January is a better way to phrase that. So the first one's going to be charitable contributions. Now, charitable contributions is significant in 2025 versus 2026 because the tax laws are changing. So what's going to happen in 2026? You're going to be able to make a charitable contribution and take the standard deduction. Right now, that doesn't happen in 2025. So if you made a charitable contribution in 2025 and you're taking the standard deduction, you're not going to be able to go ahead and get a deduction for the charitable contribution. So if you're somebody who takes a standard deduction, maybe hold off until January to actually make that contribution so you can actually see some kind of tax benefit from it. If you're itemizing, it's a different approach, because in 2026, now there's going to be a floor, a necessary amount that you have to actually contribute before you can actually deduct it as an itemized deduction. So in that situation, you probably want to go ahead and accelerate those contributions in 2025, so that way you don't have to worry about that floor as opposed to waiting until 2026. But that's a timing example, right? Between whether we want to do this in December or January. Medical expenses, if you're close to that 7.5% floor for medical expenses, then you want to go ahead and consider, should I make my medical expense payments in 2025 or in December, or should I wait until January to actually make those payments? Now, you have to be itemizing to be able to capitalize on it, but if you're close to that threshold, maybe it makes sense to go ahead and do it in December. Property taxes and state taxes, again, this is if you're an itemizer. If you're a standard deduction, this doesn't apply to you. But if you're itemizing it, those can help you in the current year. So you want to see what your tax rate is going to be in the current year as you make that determination, whether you want to pay it in 2025 or you want to wait until 2026 to pay it so you can take that deduction. Business expenses are always going to be a key one. Do you want to go ahead and invoice people in 2026 or in January, so that way the income you receive will be in the following year? Or do you want to go ahead and do it in December, so that way you recognize it in the current year? The key thing is going to be, what year am I expecting to have a higher tax rate? If I expect my tax rate is going to be higher in the next year, in say 2026 versus 2025, well then I probably want to go ahead and collect that income immediately in 2025, so I'm not being taxed at that same marginal rate. I'll be taxed at a lower rate. Or maybe if I'm being taxed in 2025 at a higher rate than next year in 2026, I want to go ahead and accelerate payments to my suppliers, so I'm getting my payments out there, so I have an expense in the current year in 2025, so I can reduce my taxable income. And then retirement contributions are the same thing. Look at your tax year to determine how you want to handle those things. Now we go over to the next column over here, and this the do if. So these don't relate all the way across. So I'm not saying charitable contributions, higher tax bracket this year, and then don't do if the higher income next year. These are independent. So here's when you're often looking at trying to accelerate your deductions. Excuse me. Higher tax bracket this year. If you're in a higher tax bracket this year, it means your marginal rate is going to be higher. Those deductions are going to be more valuable to you. Unusually high income this year. So maybe some things happen to where you were very successful this year. You got a huge order this year. Maybe you sold some business assets this year. Who knows what it is? Maybe you got a large bonus this year. Well, you want to accelerate those deductions to help offset that income because it's pushing you into a higher tax rate, most likely. And then finally, to reduce AGI for credit eligibility. So are there any adjustments that you'd be able to make, those different adjustments when we talked about the tax forms? Well, if we can reduce our AGI, it may make us eligible for some of our tax credits, and even some of those are refundable. We love that. We love tax credits though. But there's different amounts, right, where we phase out and we aren't going to be eligible. Well, if we take those deductions and they're above the line deductions, maybe that helps us qualify for our tax credit. So we'd want to take a look at it from that perspective as well. Don't accelerate your deductions if you have higher income next year, or there's deduction limitations that you're already at, such as the state and local tax deductions, right? So you might not want to accelerate those, because if you do, you're getting no benefit out of it. Or if you're already at zero taxable income, you're not getting a benefit out of taking those other deductions. Push those back to the next year, and that way you're still going to be able to capitalize on those. So we're talking about deductions here. Let's go talk about income and whether we want to accelerate income or whether we want to defer income, and in what situations that's going to be helpful for us. So here's what we're looking at in terms of income and whether we should accelerate it or defer collecting, those types of situations. Now on the left hand side in the blue, we have different examples. So first one's business owners delaying invoicing. So I mentioned this a little bit earlier, but if you are a business owner and you have some receivables that you now need to go ahead and start collecting on, well, maybe you wait until January in order to start collecting on those if you want to go ahead and postpone it, because that's when you'll start to collect it. That's when you're going to be taxed on it. Otherwise, you can go ahead and you can do this in December if you want to go ahead and be taxed on it in the current year. Make those invoices, send them out, collect the money. You're going to be taxed in the current year. And we'll look at do's and don'ts, when it helps, when it doesn't in those situations. Independent contractors, postponing collection, right? If you're an independent contractor, the same thing. Well, let's postpone collection. Let's not collect it until we've actually in the tax year that we want it to be collected. So we can hold off until 2026, so until January, or we can do it in 2025 in December, and that's going to be okay for us. The other one's going to be our capital gains and timing. When do we want to actually sell some of our stocks? Do we want to wait until December and we're going to have capital gains in the current year? Or do we want to wait until January and then we'll be recognizing the capital gains in the next year, right? So maybe we get to defer them for a while before we have to recognize them. But again, it's going to depend on a lot of different issues. And the issues are going to be under the do if, which is going to be our green category. So we do these different types of trying to accelerate or trying to defer income based on these situations. So if you have a lower tax bracket next year, right, then what may happen is you want to go ahead and not collect in the current year. You might want to defer income recognition until the following year. Why would we have a lower tax rate the next year? Well, maybe we had an unusually high tax year this year. Maybe we got a large bonus that we don't expect to be able to get again. Or maybe our filing status has changed. Maybe there's a divorce on the horizon coming and you're going to fall down to a different tax bracket. And maybe that's not going to be beneficial to you. So that could be a type of situation. Maybe you're head of household, but you're not going to be able to claim your child as a dependent any longer. Maybe you're retiring or you're going to phase down to part-time, so you're not making as much income. Those things can reduce our tax, our funds for the next year, and it can lower our tax rate. Increased income this year, so sale of assets or bonuses. So maybe we had a high tax rate this year. Well, if we go ahead and defer, we're going back to a lower marginal tax rate, or at least that's what we're hoping. It's going to be a lower marginal tax rate. Or we have credit or deduction thresholds. If we're going to be if we collect and it's going to push us over the threshold, we may lose credits. And remember, a credit is a dollar for dollar reduction of our tax liability. And those are so beneficial to us. But if we phase out, we're not going to get that. So maybe we're like, hey, let's not take our income now. Let's collect that next year. So that way we still get our credit this year. And then we'll figure out next year what we're going to do. We'll have our strategy and we're going to continue to make sure that we're maximizing our tax benefits. But here's some things that you don't want to do it. So if you're expecting higher tax rate next year because you're getting that raise that you've earned, you know there's going to be a bigger bonus next year. Your filing status is going to change. There's other tax changes in your life. I mean, so whatever it is, if it's going to result in a higher tax rate next year for you, then, recognize that income in the current year, or at least balance it as a consideration. I shouldn't say it's an absolute rule because that's not necessarily true, because you also want to see, are you going to phase out of any type of tax credits, right? So it's a balancing thing when you're looking at all this. Cash flow needs. Hey, you know what? If you have a business, maybe you have the cash flow needs. Or as an individual, maybe you need to collect that income because you have to meet household needs. Kids need braces. Maybe there's a surgery. Maybe you're paying for tuition. I mean, you need a new car. You need to repair your car. Who knows what it is? Sometimes we don't have the luxury of this timing issue, especially when it comes to collection of income. So, that's just a realistic confine that we have to operate under, and we need to be making sure that we're maximizing the health of the taxpayer. The third one's going to be recognition rules. So sometimes we can't defer the income. So there's sometimes constructive receipt. If they've paid us, we can't say, well, I haven't opened up the mail yet. I'm not going to be taxed on it, or I'm not checking the mail. No way. Not until next year. Hey, if they've already paid and we have access to it, we've got to recognize it. We can't defer it. All right. That happens. Or if we're using the accrual method, which happens with some businesses, that it's when you've earned the income, not when you've collected the income. So we wouldn't be able to defer it in those situations either. So those are our basic situations that we're looking at. But you know what? There are mistakes that taxpayers use, some common mistakes that we can learn from. So let's go ahead and take a look at those different mistakes. So hopefully you're not making the same mistake when you're doing your tax planning or you're working with your tax professional. So you've been hearing me, if you've watched the first two videos now, or the first video when you're going through this video, you're hearing me talk about things like make sure we're being proactive and not reactionary. And in the first video in the series, I went ahead and I talked about things like our general rule is we want to go ahead and defer income and we want to accelerate deductions. And those are kind of rules of thumbs, but they're not absolute. Well, sometimes when you're in tax and you're having tax season and you're thinking of all these other issues, because tax is already complicated, that you lose sight of what you're trying to accomplish. So you want to be proactive, but always remember what you're trying to accomplish and why you're making a specific move. Don't just follow a move because somebody else did it or because you watched my YouTube video and it says, hey, here's our rule of thumb, because you need to be able to think about how it will impact you. So let's look through this. The first one is accelerating deductions without benefits. A lot of times people will follow a rule of, hey, you know what? I need to go ahead and I need to accelerate my deductions in the current year because of time value of money, blah, 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 right? Well, hey, maybe not. Maybe not. Maybe you're already at the 0% tax rate. It's not going to help you at all. Or next year, you're going to be at a higher tax rate. You're using your deduction and it's benefiting you with a lower marginal tax rate. So your benefit's much smaller than it would have been when you were taking it against a higher marginal tax rate, because we love deductions that are against higher marginal tax rates. Okay, because it's more valuable to us. Now, there are times that even if it's a higher tax rate next year, maybe you're going to be offset because of your credits are going to be better this year and you need to lower your AGI. So maybe there's a situation that you're going to want to go ahead and take them anyways, so that way you can get to the credits. But understand why you're making the specific move. What is your reason, and understand that reason. Second one, deferring income into a higher tax year. Yeah, we don't want to pay taxes. And I agree with you. And you know what? Even sometimes you got to be careful with the professional here, tax practitioner. Most of them are really good. But here's some things that sometimes happens is, there's so much pressure out there to lower our taxes for the current year. So that way you see the benefit that you're receiving. Well, you know what? Sometimes you say, hey, based on your tax situation, you're going to be at a higher tax rate next year. I'm going to accelerate it and try to get things so we're recognizing them in the current year, even though that results in higher taxes for you now, but it's going to be offset next year. So next year is where the real benefit comes in. So understand where your tax year is going, kind of making those projections, working with your tax professional, or if you're not using a tax professional, understanding, okay, what will I be likely paying next year? Do I think I'm going to get that raise? Am I going to be working a side gig? Anything like that, right? That might increase your taxes. Maybe you want to accelerate the recognition in the current year. Third one, ignoring phase outs and limitations. Okay, so sometimes we do have limitations on how much we can take of something. So we need to be aware of what that limit is. And if once we know the limit, then it doesn't make sense to continue to pile on with deductions or things like that if we're already going to be maxed out. So if we're itemizing deductions, well, we have limits in terms of state and local taxes, right? So maybe we're not trying to make that amount as high as we can in the current year because it's bringing zero value to us. So we want to hold off to the next year so we can bring real value to our clients. Okay, so or to yourself. So that way you're going to be able to go ahead and capitalize on that. Missing documentations or payment rules. So always make sure that you have the documentations for what you're dealing with. Payment rules deal with things also like constructive receipt that we just talked about. If you receive the payment, hey, you can't just defer things because you already received it. You have constructive receipt. You could go cash a check if you wanted to do that. And then the final one is assuming timing works the same for everyone. Look, whether it's my videos or talking to your friends, family, seeing things on TikTok, whatever it is, understand that first off, if you're seeing it on social media, always question and look to see who it is that's providing and whether they're providing good information. But just because, assuming they are providing good information, just because it worked for them doesn't necessarily mean it's going to work for you, because the tax code is complicated and you need to understand how it's going to impact you directly. That's why we have tax professionals. It's not a one rule fits all. It's based on the individual circumstances. At least good tax planning is based on the individual circumstances. So don't compete with other people that you're hearing. Understand that your situation is unique and it should be treated that way. Whether it's with a tax professional or with yourself doing your own taxes, that you know what your financial health is and what you're trying to accomplish, and that you're pursuing that goal. All right. Well, I hope this video was helpful on these timing issues. Because I've been talking about AGI so much in this video, especially for like thresholds, what I'm going to do is my next video, which I'll post tomorrow, is going to be a video that deals with ways that we can reduce our adjusted gross income, which is one of the most important lines in the tax formula. So we'll spend some time going through that, making sure you're ready to use different strategies to try to reduce your AGI. In the meantime, subscribe to my video and have a good evening.